As you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
But the damage is already done.
Keeps kicking. America's largest companies are down, all of them in the market since the Trump tariff war began.
The chief executives of Walmart and Target have privately warned President Trump of empty shelves in the coming weeks if he continues with his tariff. We're hearing from the ports on the west coast of America, Los Angeles in particular, of a potential collapse.
Trump tried to make America first with tariffs. But maybe he should have done some math first. Because these tariffs aren't hurting foreign rivals, they're crushing American companies. They're the reason people are losing jobs, slipping into poverty, and paying more for less. Now, 5 corporate giants that fuel nearly half of America's employment engine are walking away. Can you blame them? Who wants to stay and build in a country that penalizes you for doing business? These companies aren't waiting for Washington to figure it out. They're leaving, quietly, strategically, and they're taking jobs, investment, and stability with them. John Deere. At number 5 on the list of U.S. giants making their exit, we have a name no one ever expected to leave. John Deere. The iconic company, founded in 1837, isn't just a brand, it's a cultural cornerstone of American agriculture. With over $60 billion in revenue last year, it has long been synonymous with reliability, innovation, and the American dream. But in 2024, after nearly 2 centuries of loyalty, Deere is quietly walking out the door. And make no mistake, this isn't about the allure of global markets or the siren song of lower labor costs. It's about Trump's policies. The Trump administration's 25% steel and aluminum tariffs didn't just dent Deere's profitability, they drove a wrench into its production costs. When CEO John May tried to push back, Trump doubled down, threatening a staggering 200% tariff hike. That's not protecting American industry, one analyst quipped. That's torching it. The fallout was swift and severe. Deere's exports to China plummeted by 17% in fiscal year 2023 as retaliatory tariffs kicked in, closing doors in one of their biggest growth markets. Meanwhile, their Q3 2024 profit margins crumbled to 14.8%, triggering a desperate wave of cost-cutting measures. The company's response? A strategic pivot that feels more like a retreat. Lower-end tractor production has already shifted to Mexico and India, with internal memos citing policy volatility as the driving factor. Back home in Iowa, over 400 jobs at the Dubuque Works plant are now dangling by a thread. And in a move that speaks volumes, John May didn't mince words with investors. The global environment is more predictable than Washington. This isn't outsourcing, it's a calculated evacuation. Deere isn't chasing cheap labor, it's fleeing political chaos. As one employee put it, we're not just losing jobs, we're losing a legacy. The question now isn't just who's next to leave, but whether anyone will be left to stay. At number 4 on the list, we have Amazon, the company that made 2-day delivery. An expectation is now delivering something else entirely, an exit plan. Once the unrivaled logistics empire of America, with over 1.5 million employees worldwide in operations in every major U.S. state, Amazon is quietly shifting gears. Since mid-2022, it has canceled or paused more than 40 warehouse projects, including flagship developments in Orlando, Dallas, and Kansas City. As these U.S. sites faded, new logistics hubs rose in India, Poland, Brazil, and the UAE. This isn't just expansion, it's strategic rerouting. The catalyst? A Trump-era tariff slapped hefty 7.5% to 25% import duties on Chinese-made components for products like Kindles and Echo devices. Every box shipped turned into a costly tax burden, forcing the company to rethink its operations. CEO Andy Jassy didn't mince words, calling the tariffs unpredictable taxes on global innovation. By 2024, the fallout was clear. Prime fees increased, domestic infrastructure plans were gutted, and procurement began pivoting away from U.S. suppliers. Internal memos leaked to the Chamber of Commerce revealed that over 27,000 logistics jobs in the U.S. are now hanging in the balance. The once vaunted Buy American initiative? Barely breathing. Amazon's retreat isn't just a business decision, it's a survival strategy. The company that redefined convenience is now recalibrating to serve a global market less entangled in political battles. The market's reaction? A collective shrug, because this wasn't an overnight collapse, it was a slow erosion caused by policy friction. For Amazon, the shift marks a departure from its US-centric identity. For the rest of America, it's a warning. When innovation meets punitive politics, even giants look for the nearest exit. The question is, who will follow? At number 3, we have the retail titan of America, Walmart. With over 4,600 stores and a hold on U.S. consumers like no other, Walmart has long been a bellwether for economic trends. But in May 2025, that bellwether sounded an alarm. During an investor call, Walmart made it clear tariffs are strangling our margins. And the fallout was immediate. Internal memos revealed the company's plans to hike prices not just on luxury items but on everyday essentials like food, toiletries, and household goods. At the same time, Walmart began slashing inventory orders and freezing contracts with thousands of U.S. suppliers. Instead of buying American, they ramped up sourcing from Vietnam and Thailand, where goods don't come with a punitive tariff tag. The numbers tell a grim story. Walmart cited import duties of up to 30%, depending on the product. Combine that with retaliatory tariffs from Mexico and China, and you've got a perfect storm hammering food distribution and electronics. In the first quarter of 2025, Walmart's profit margins dropped by 2.1% compared to the previous year, forcing cost-cutting measures across hundreds of Midwest locations. CEO Doug McMillon didn't sugarcoat the issue. We can't protect prices if policies don't protect business. And when Walmart starts pulling back, it's not just a red flag, it's an economic forecast. Walmart has the scale and resources to weather some storms, but if even they are retreating, imagine the pain for smaller retailers who lack such safety nets. For decades, Walmart has been synonymous with affordability and abundance. Now, as it navigates a minefield of tariffs and policy uncertainty, even this retail giant seems vulnerable. The question looming large: if Walmart can't win the tariff game, who can? Next on the list is Nike, the $50 billion global powerhouse that once proudly showcased its American roots. Now, the iconic swoosh is retreating, unable to endure the escalating costs and challenges of operating in the U.S. In April 2025, Nike announced it would raise shoe prices by $2 to $10 per pair starting in June. The culprit? Over 52% of Nike's footwear is manufactured in Vietnam, and those imports now face tariffs as high as 46%. Add the long-standing 36% base footwear duty and surcharges on premium lines, and you've got a recipe for soaring costs that even a giant like Nike struggles to absorb. The company's response has been decisive. Expansion plans for its North Carolina distribution hub are indefinitely frozen. Instead, Nike is doubling down on its supply chains in Vietnam, Indonesia, and Cambodia. While regulatory environments in these countries are stringent, their predictability offers a stark contrast to the volatile U.S. trade policies. Signs of Nike's retreat from the American market are increasingly visible. Internal board memos now label U.S. operations as risk-averse. Marketing budgets for key partners like Foot Locker and JD Sports have been slashed by 38%, while retail discounts have all but vanished. consumers are paying full price for Nike products, not to boost the company's bottom line, but to offset tariff-related margin losses. A Nike executive encapsulated the frustration. "We can't keep selling shoes that cost more to land than to make." The statement underscores a seismic shift in strategy. The brand that inspired millions to just do it is now signaling just not here. This retreat isn't just about balance sheets. It's a symbolic blow to the U.S. economy. For decades, Nike has been more than just a brand. It's been a cultural icon and a standard bearer of innovation and growth. Now, it represents a cautionary tale of how erratic trade policies can drive even the most established corporations to rethink their American operations. If Nike, with its global scale and market dominance, can't weather these challenges, what hope is there for smaller companies? Nike's pivot away from the U.S. signals a sobering reality. Staying competitive in an unpredictable market may simply no longer be possible. Topping our list is Caterpillar, the world's largest heavy machinery manufacturer and a long-standing icon of American infrastructure. Based in Peoria, Illinois, Caterpillar has been synonymous with the grit and steel of U.S. progress. Yet the company is now systematically dismantling with Swift. To make matters worse, the European Union rolled out new certification requirements, amplifying the logistical nightmare. The company's response? A strategic review its American roots, thanks to the turbulent tariff policies of the Trump era. In the first quarter of 2025 alone, Caterpillar reported a staggering $350 million loss attributed directly to these tariffs. Unlike corporate euphemisms that bury bad news, Caterpillar's earnings report called it out plainly. Steel tariffs stood at 25%, and retaliation from key markets like China and Australia under the guise of managing unpredictable policy risks. The subtext? They're making an exit. The fallout has been nothing short of dramatic. Caterpillar has already relocated key production operations, with engine components now manufactured in Brazil and assembly lines moved to Indonesia and the Philippines. Between 2024 and 2025, over 3,200 American jobs have been slashed or indefinitely frozen across facilities in Texas, Illinois, and Georgia. CEO Jim Umpleby encapsulated the frustration with a single statement. "We're paying 3 times to build the same bulldozer, once in tax, once in compliance, and once again to fix it." For a company literally and figuratively building America, the sentiment couldn't be clearer. Caterpillar's message? They're done building here. This seismic shift reveals the ripple effects of erratic trade policies. Once an emblem of American industry, Caterpillar now serves as a cautionary tale for what happens when global companies face domestic unpredictability. As their bulldozers move offshore, so does a piece of the nation's industrial legacy. Was this really economic protection, or just self-inflicted collapse? Let us know what you think. Is this the cost of standing tough, or a warning we ignored for too long?